So, Joe, how much importance should we give to this adjustment in the forecast?
I think it's very important to not have seen this for the last 12 years. And we're also seeing a big bifurcation in the strategists as well. The 325-point range that we see from the most bearish to the most bullish forecaster is the widest to start a year since 2012. So there's a lot of uncertainty going on, and it really boils down to several things. First, you have the slide in oil down about 50% from last year's high, as Matt was just outlining. You have the slowing global growth that's stemming from economic data from China, and then you also just have a third straight quarter of earnings contraction. We're actually currently in the middle of earnings, and we've really seen some weakness, particularly in the tech sector at the end of last week.
All right, Richard, with more and more analysts suddenly saying we're scared, we don't like this, and others, Goldman's still out there saying they think there's only a 25% chance of a U.S. recession. How do you make sense of all this? How do you see the world?
Well, I don't see the world in short-term snapshots. I see the world in a very long-term picture because my business is a long-term business. If I'm planning a real estate project, it's not going to happen in a day. It's not going to happen in a week. It's not going to happen in a month. It's going to happen over a period of years. Frankly, the cheap cost of money now makes my business super attractive because I can go out now and borrow money with the 10-year at 1.8%. I can borrow long-term capital under 4%, and that's very, very helpful in the development business.
So for you, it doesn't matter if the U.S. is headed for a recession?
Well, yeah, sure it matters because the psychology of people changes, and, they get a little negative, and yes, it's going to hurt the retail business, and maybe office leasing will be a little slower because corporations are going to not be willing to take on personnel so readily. All those things hurt, but remember, this is a point in time, and the things we do take years to do, and then they're assets that have durability. They're going to last 20, 30, 40, 50, 60, or 100 years. So I don't think about things of the moment.
It is a point in time, although we're getting quite a few of these points in time now. They're starting to stack up a little bit. And at what point do all of these indicators start to make you think twice about where we're headed longer term in global growth? Are we headed toward secular stagflation?
No, I don't believe that for 1 minute. I don't believe that these momentary market movements really indicate anything. Remember, my business is a business of demographics. It's a business of people. Is the population going to get smaller as a result of the move in the market? No, it isn't. So these events, Warren Buffett, I think, said famously once, if you owned a farm and there was an exogenous incident in some place around the world, would that cause you to sell your farm? If you owned an apartment house, right, people stop paying rent because there's a war in Pakistan, for example. So I don't believe any of these things are moments, but this is the trading mentality of Wall Street today, and that's what you got right now.
Joe, then is this the problem? That it's the trading behavior of Wall Street? If you liked these companies last year, you should love them now because they're cheaper.
That's a good point, and we just saw a bunch of the tech companies that were previously considered overvalued sell off big time at the end of last week. The PE ratio for the Nasdaq is at a multi-year low, and another interesting dynamic going on is actually the high-quality companies, the ones with the earnings growth and the 12-month sales growth. Those are the ones that are outperforming this year. There just aren't enough of them to prop up the market, and actually a dirty little secret of the bull market is that companies with the most leverage and with the weakest balance sheets were actually the ones that drove the gains for the first 5 years of the 7-year bull market that we're in.
Now, I would say that if I was selling, super deluxe condominiums in Manhattan today, I'd be a little nervous about what's going on because my buyers wouldn't be too happy about writing big checks now. But, that's just a tiny little segment of the real estate business.
Then how do we protect the economy? How do we protect these companies, their earnings, their employees from short-term trading?
Well, I think it's up to the management to protect them, right, and their boards of directors to protect them. If they keep their leverage ratios down, if they have strong capital positions, if they have proper balance sheets, these things will be weathered. These moments will be weathered. If they're in a business that's being outmoded, and there are businesses that are being outmoded every day, well, then it's time to look into something else.
So Joe, to go back to your piece, it strikes me, and this is what Stephanie was talking about, these predictions about the market came out only within the last 30 or 60 days. They're not like 6-year projections.
I love this.
Well, I can't think of any major events since those predictions were made that would change your view. It's more of the same. China was slowing down, oil was down,
Right.
you know, Europe was struggling. It was all true.
Here's the event. Analysts were riding the momentum train just like with every investor.
That's right.
Yeah, there's really no silver lining. They're all kind of coming together at the same time. And we've long talked about the strong dollar hurting earnings for multinational companies. Guess what? The dollar's still going up. The China situation hasn't really shown signs of improvement. We haven't gotten extremely good economic data that the Fed might want to see to maybe do another interest rate hike. So there's a lot of things kind of coming together all at once that are really causing uncertainty amongst investors. And that's why you're seeing such a big range of strategist forecasts.
Yeah, well, then I guess the question to investors, find a view, take a position, let's go. If Richard can do it, so can you. Thank you, Joe Ciolli of Bloomberg News.